Now, in terms of the ACCA do provide us with some useful information in terms of standards in this area. November 2021, the ACCA issued the following sort of reporting standard, as it were, and it's very, very comprehensive. Now, this is probably a little bit sort of OTT or over the top for an exam, but it's certainly quite useful to take a look at the ACCA's view on reporting and, broadly best practice. So what do they say? Well, in essence, they talk about covering or reporting to cover a broad scope of topics, that sort of highlights the interactions between the value that organizations create for themselves and the impact. So really, in terms of number one there, it's about balance, isn't it? The ACCA realized that for-profit organizations have a duty, indeed the directors have a duty, to the shareholders to get a return. But they also have a duty to society and indeed the planet. So really, in effect, what point number one says is, yes, report on value, the value that you create, but also report on other important areas. Next point here is, be based on a common language and clear definitions. What we don't need within reports, according to the ACCA, is any sort of ambiguity. To use understandable, simple, common language and indeed clear definitions. In terms of number three, they suggest that reporting, broadly speaking, should, have some sort of balance between principles-based, for example, in relation to corporate governance, and indeed, providing a minimum core set of comparable metrics. And when we say comparable metrics, we're talking about the ability for an organization to produce metrics that can be used to compare that organization, perhaps in terms of its emissions or other areas of importance, to other organizations. Number four, this is an interesting one, avoid disclosure overload. So in essence, make sure that the presentation and indeed content of reports, is easy to use. What we don't need is too much information. We need the users of the report, perhaps society, other stakeholders, that be able to easily access the information that they're looking for. Point number five is the old cost v benefit issue. Clearly, if we are reporting, perhaps on a voluntary basis, businesses do need to balance the cost and benefit. Number six, there's a suggestion here about a sort of a building block approach. In essence, what we're talking about there, if we think about IFRS, we have a set of standards, and really what we need to be able to do is to sort of build from a base set of standards, if you will, a baseline, to use the word used here, on which sort of national and indeed regional standards can be built. Number seven, achieve reporting that is assurable. People need to have confidence in reports, whether or not they're obviously mandatory or indeed in particular voluntary. The assurance of those reports, the accuracy, veracity, etc. is key. Point number 8 for small to medium-sized enterprises, certainly be proportionate and focus on the information that improve business management. So really, focus on what's important and indeed leave out what isn't, particularly for SMEs where cost may be an issue. In number 9, in terms of technology, obviously in terms of tech and tech disruption to a variety of different businesses and industries over the years, let's make sure that we use reference to tech in the right way. Let's look forward from there towards integrated reporting. Now, as mentioned at the outset, integrated reporting is a very, very common topic in the SBL exam, and unfortunately in my experience of marking mock exams, sometimes, at least 50% of the time, it's not well dealt with by students. I'm not really sure why. Integrated reporting is a fairly straightforward topic. There's nothing of any technical difficulty within it. So it's really a topic that we should be on top of, given that it comes up regularly, and indeed over and above that, given that it's not that difficult to understand it. But what do we mean by integrated reporting? Well, let's take a look. We're talking about concise communication about how an organization's strategy, governance, performance, and prospects in the context of the external environment lead to the creation of value in the short, medium, long term. Now, a couple of points here that are important. Firstly, concise communication. The information needs to be presented well. The integrated report needs to be presented well. It's about a variety of issues that when you consider traditional corporate reporting or traditional financial reporting, we, in history, in the past, we wouldn't have seen too much mention within a standard annual report, profit and loss balance sheet, cash flow statement, etc., of these areas. And this information is important because, in essence, a business creates value in many, many different ways. Value isn't simply just the difference between revenue and expenses. For example, value is created in terms of training staff. That creates value. Value is created possibly in relation to the local community. So really, what we're saying here in terms of this definition of integrated reporting is that integrated reporting provides more information on important areas, and indeed in the context of the external environment, for users about what companies are doing to create value. Now, note that guidance would suggest it needs to be specific and indeed identifiable. What we mean by that is that the information, or indeed the report itself, needs to be specific. It needs to be able to be seen easily. We need to understand that this is an integrated report, and indeed we need to understand the purpose of it. Now, in terms of possible methods, as it were, it could well be just a standalone integrated report, or it could possibly be some sort of part of another report. For example, generally speaking, a lot of companies would include an integrated report within their annual report. But certainly it should be distinguishable, prominent, and indeed accessible. Okay? So really, in essence, what we're saying in this sort of intro to integrated reporting is that integrated reporting is important. It needs to be, broadly speaking, identifiable in the sense that it's very, very clear that this part, or this document, this part of this report, is an integrated report, and indeed will be produced in line with current best practice. Moving on from there, when we talk about goals of integrated reporting, and I think this is quite important here, this term, integrated thinking. The suggestion here is that reporting in this way, IR, reflects integrated thinking. What does that mean? What does integrated thinking mean? It means really application of the collective mind, the combined mind of those charged with governance, in other words, people involved in running businesses, and indeed the ability of management to monitor, manage, and communicate the full complexity of the value creation process, and indeed how this contributes to the success of the organization over time. That's quite a mouthful, a lot of information. Let me just break that down. Really, what we're saying is that in one sense, an integrated report should help the user get into the mind of the management, to understand, how the management plans and does go about creating value, and indeed, assuring its future. Okay. Now, the background, I guess, to integrated reporting, outside of obviously the need over the last 30, 40, 50 years for something more than standard financial reporting, is really the IIRC, the International Integrated Reporting Council. Now, what is that? Well, in effect, a council made up of a variety of different relevant and indeed interested stakeholders, from everything from regulators to companies themselves, standard setters in the accounting profession. So we've got about the best group of people on this IIRC that we could have in order to assist with the development of integrated reporting over time. And certainly when you look back, let's say for 20 years or thereabouts prior to integrated reporting being in existence, certainly it's come on tremendously since the early days. So next key point for us is in terms of background. So we know what it is, we know what it should be, we know that the IIRC are going to provide us with assistance and guidance and standards, etc. What's the background to IR? Well, as mentioned, when we think about historical financial reporting, really financial information is insufficient. When we think about the long-term sustainability of the company, in other words, its existence over the long term, financial information isn't really good enough for numerous reasons. But the first reason is it's historic. It's not forward-looking, okay? So there's the first issue in terms of the creation of IR. So what does IR do? Well, you know, it combines certainly financial information, which is obviously important to businesses, with non-financial information to really maximize value. So really what we're talking about is a document, a report that provides a lot of information really to give the user much more value about how a business creates value. So what are the goals really of IR? Well, firstly, as you would have thought, quality of information. Secondly, you know, to sort of guide towards a more cohesive and measured approach to corporate reporting. And indeed to give people more confidence, you know, about the accountability of people running businesses, of directors, of managers, etc., and indeed people in that stewardship role, you know, people who are really tasked with looking after businesses' assets for others, or for, you know, for people that actually own them.